Last quarter, Coca-Cola posted an 8.1% increase in third-quarter profit, due in part to raising retail pricing 2% in North America, a move analysts say was long overdue.
When Coke wasn't taking pricing in the first half of the year, volumes were weak. So they're taking pricing. Volumes are a little bit weaker, but the overall profitability is better.
Better, but analysts still say North America is the slow growth area for all consumer staples companies, including Coke. One obstacle, a growing obesity and diabetes problem in the U.S. that is raising awareness and concerns about sugar-sweetened beverages that could lead to higher regulations of the industry. But the two men in charge of running Coca-Cola's North American business remain optimistic, pointing to the region's 6 quarters of growth as a sign of things to come. However, they don't take anything for granted.
We have to assume it's very tenuous. We sell drinks one at a time, every day, for cents at a time.
We're not satisfied. We know that there's more.
And they hope to squeeze more out of further synergies from Coke's acquisition of its biggest bottling operations in North America last year, an action Coke took on the heels of a similar move by its chief rival, Pepsi. Coke's purchase helped eliminate redundancies in sales forces, cut costs, allow the company to work more efficiently and directly with retailers on brands and package sizes, and reinvest in the business. The question is, are the efficiencies and cost savings done?
We've executed our plan. We announced that over the course of 4 years, we'd have $350 million worth of synergies. We're ahead of that. And as we got further and further into it, we saw more and more opportunities.
How much more?
Well, there's more.
Only time will tell how much more. As for the future, Douglas and Kaolane continue to take a page from the company's Latin American business, where the Coca-Cola brand is the star of the show and everything revolves around what customers want and are willing to pay.
So whether it's a 3-peso returnable glass bottle in a lower economic area, Mexico City, or a 16-ounce one-way plastic bottle in an upper income area, they have, with their bottlers, built the capability to properly execute to meet the specific needs of consumers wherever they are in the country.
Meantime, back home in North America, Coca-Cola will have to continue to pay higher prices for commodities on things like corn syrup used as sweetener and petroleum-based plastic for bottles and packaging.
The commodities are still going up fairly aggressively.
Right.
So it's going to put a premium on the capability that we've built together to operate multiple package formats and multiple customer segments to make sure that we have the right price points for the time of the month, the customer, and the occasion.
In other words, make the right decisions and do it in a North American beverage market filled with an ever-expanding array of choices for consumers and where Coca-Cola goes head-to-head with its chief rival, Pepsi.
Certainly Coke's biggest competitor has been and will be Pepsi. Pepsi's a very formidable company, great brands. Coke has been outperforming Pepsi for last year and so far this year in what are called LRBs, liquid refreshment beverages. But Pepsi has made some changes, and they're probably on the cusp of doing much better.
Coca-Cola's Douglas welcomes the competition.
In my 20-plus years in the business, there have been times when we were great and our competition wasn't as great, and there's been times when they've been great.
And it can change quickly, can't it?
It can.